Hello, and thank you for joining us for today's Scientific Beta webinar. Today, we will be presenting several articles from the latest EDHEC Research Insights supplement to AsianInvestor. First, there will be a presentation on the robustness of smart beta strategies made by Dimitris Korovilas, investment specialist at Scientific Beta. Then a presentation on the value factor by Felix Goltz, research director at Scientific Beta, who will be joined by Ben Newton, quantitative research analyst at Scientific Beta, who is co-author of the article. The third presentation will be on Scope 3 emissions and made by Frédéric Ducoulombier, ESG director at Scientific Beta. Then Eric Christensen, ESG and low carbon investment specialist at Scientific Beta, will be presenting an article on engagement and investment in the ESG space. And finally, Daniela Gay, index director at Scientific Beta, will be speaking about the benefits of the historical volatility adjustment risk control option. If you have a question on any of the topics, you can use either the Q&A function or the raise hand sign at the bottom of your screen. We will address the questions at the end of each session. So I will now hand over to Dimitris for the first presentation on robustness of smart beta strategies. Thank you.
Thank you, Severin. Hello, everyone. Thank you for being with us today. So the first presentation is about a paper that we investigate. Let me be here. Yes, we investigate and we examine the issue about whether robustness is important for investors in smart beta strategies and in multi-factor strategies. And we are motivated by this topic because usually we see strategies that either experience an out-of-sample degradation in performance when they are launched, or they start to behave differently from what they are supposed to behave based on their construction principles. So given these contradictions in the marketplace, we examine and we see that there is a lot of common sources of lack of robustness in the index design of strategies, and we present these in the paper, and we also give some representative examples of this lack of robustness in the construction of popular strategies out there. And also we offer the ways by which Scientific Beta, in our index construction, we avoid these traps or these problems with robustness, and our indices, as a result, have the characteristics, the required characteristics by investors, which is for multi-factor products, strategies that have a good factor exposure quality. And what this means, it means that these strategies benefit from both strong factor intensity and factor diversification. So having both is your ticket to out-of-sample robustness, out-of-sample potential, because you do not depend in the lack or otherwise of one or two factors performing well in a particular period. Now, on top of the discussion about robustness in index design, sometimes it's difficult to spot such problems, it's useful for investors to have a quantitative tool set to evaluate robustness. And this is what we also discuss in this paper. We offer measurements by which investors can see whether the strategies they examine are actually performing or behaving according to their objectives. So with this in mind, I will quickly show you some results and some discussion from the paper. First, on the theory part, is here, this table is a quick summary of the arguments in the paper, whereby on the left-hand side, the column is talking about the common problems with the lack of robustness. The column in the middle offers a representative example of this lack of robustness in a popular product in the marketplace. And on the right-hand side, you have the way by which scientific beta improves robustness by making some simple and transparent decisions in the index design phase. So the sources of lack of robustness can be categorized, as we can see on the slide, on topics around factor definition. So strategies usually fall in the trap of factor fishing or picking redundant factors. So this is a topic that falls under the umbrella of data mining sometimes, where you try to find always the best definition that works well in sample, or you always try to find a new factor that seems to work well. But in reality, what you're doing, you're moving away from the 6 well-rewarded factors that have been justified in the academic literature, and they are exactly justified because they possess an economic rationale. So there is an economic intuition and reasoning behind why these factors offer you a premium. Similarly, you have model mining problems on the way you construct the strategy. You have, usually you see strategies with high exposure to unrewarded risks. And also you see strategies that often depend on the performance of a single or of a couple of factors instead of the full suite of factors. So they don't benefit from any factor diversification. And the way we solve this problem at Scientific Beta is with our high factor intensity filter, whereby when you construct a single factor sleeve, this filter allows you to filter out, to remove negative exposures to all the other rewarded factors. Therefore, when you combine single factor sleeves constructed this way, you end up with multi-factor strategies that have the required characteristics of strong factor intensity and factor diversification. So exposures are spread out between factors, and as we said, this is your ticket. This is the benefit you are looking for out of sample robustness. So when we move to the quantitative part of the paper, what we do is with our tool set of robustness measures, we examine popular strategies and also compare it with scientific beta strategies. And the first important check you do in this robustness framework is exactly looking at factor exposures and looking at factor exposure quality. So the main takeaway is that because of the problems I described, if you see at the average column of investors, you can see that down here, the numbers about factor intensity, the number about factor deconcentration, or the number about exposure quality, they lag behind the numbers that we see for the scientific beta indices. And what this really means is that a strategy with this shape, or I mean, you can take any of these, and especially the ones with a low deconcentration. What it means for these strategies is that they may, in a particular sample, they may be, let's say, lucky in the sense that if the factor they are exposed to works well, then they will be the winners, they will be the champions of the period. But if the particular factor doesn't work well, and we know that factors are time varying, the premium is time varying, and you have periods of underperformance and outperformance. In the second case, the strategy will be in the losers, in the loser camp, it will be lagging behind. So what you really want from a multi-factor investing point of view is to be balanced across factors, have strong factor intensity, and this will give you, in the long term, the required level of robustness, so that more or less, irrespective of individual factor performances, you can claim, you can reap the benefits of factor investing on average. And some more results before I conclude. The robustness framework we are discussing here has more dimensions. As you can see, you can measure through conditional ratios, you can measure your dependency on market situations. So the higher the number, the more dependent you are on a particular scenario or a particular market condition. we have here an outperformance probability metric. This is an empirical frequency of how often you outperform the benchmark, and it helps you go away from the problem of fixed entry and exit points. Basically, it's a rolling measure and measures this outperformance for all possible entry and exit points on a rolling basis. You can have extreme risk statistics, so you can see how your vol or your tracking error behaves on the extreme. And also you can have a Sharpe ratio test. This is an econometric test that basically tells you whether an in-sample difference in Sharpe ratio that you observe, whether it's really statistically significant or not. It helps you, it helps with, it's a data mining econometric test and helps you to identify whether an in-sample Sharpe ratio difference is significant or not. So with this overview in mind, the main takeaways is that you have many multi-factor strategies in the marketplace that have some lack of robustness in their index design, and this pops up quantitatively when you see their factor intensity and factor exposure quality. And as we said, being exposed to a couple of factors instead of the full suite of factors may work well for you if you are lucky for a particular period and those factors work well, but it can be the other way around. So ideally, you want to be balanced across factors, remove conditional dependencies as much as possible, and reap the benefits of factor investing in the long term. So with this overview in mind, Severin,
yeah, thank you very much, Dimitris.
Yeah.
Thank you. We have received one question, which is, how do you measure factor exposures in your risk factor exposure analysis?
Yes, okay, so this is a good question in the sense that out there you see many risk models trying to measure exposure with factor scores, but we measure exposure with factor betas. And this is really what investors care about, because they care about exposure to the premium. And this is what the beta is giving them, how much of the premium they are capturing. Alternatively, with the factor scores, you have the problem that factor scores are usually cross-sectional, so you don't capture the time series variation of cross-interaction of factors as you do with betas. And also factor scores are the result of stock level information, and stock level information like return estimates is a noisy measure. And in this sense, a factor score, a higher factor score for a company versus a factor score for another company that is lower doesn't mean necessarily that you are capturing more of the premium being on the higher factor score company. So with these problems in mind, it's more efficient for investors to look at exposures through factor betas.
Okay, thank you very much, Dimitris. So we can now move to the next presentation by Felix Goltz on the value factor.
Now, the value factor is an interesting one because it's also called the mother of all factors. So different investors, will make different selections among all the factors that are out there. Clearly, the value factor is the one that pretty much every investor has in their menu. Recently, this factor has come under attack. Value is measured by the book-to-market ratio, and this measure is very well established. So if you look at the literature on the book-to-market factor, this goes back to 1985. In 1985, there's a paper by Bar Rosenberg that already shows this value effect. So stocks with high book-to-market ratio are value stocks, and they tend to have higher long-term returns. Now, recently, this book-to-market ratio has come under attack, and you see a lot of claims that this way of defining the value factor is actually outdated. And this is a very common critique. So this has appeared across the press. You see it in the Financial Times. Just 3 weeks ago, there was an article in The Economist about this. So it hasn't maybe yet quite reached the tabloids, but other than that, you see this criticism pretty much everywhere. Now, the criticism is clearly that book to price may have expired because it ignores a lot of things that companies invest in, and in particular, it ignores the intangibles that companies invest in, and this is simply due to conservative accounting rules. So physical capital is accounted for, but intangible capital is mostly ignored according to those accounting rules. So we wanted to look at this criticism and really ask, well, okay, so this looks like a reasonable criticism. What should actually investors do about this? And so we analyzed these possible solutions to this problem. And this analysis is published in an article in the Journal of Portfolio Management. So that was published just in July earlier this year. So I will just present the main conclusions from that research. And I'm joined by Ben Luton, who is one of my co-authors on this paper. So Ben will join to answer your questions at the end of the presentation. So what did we look at in this paper? Well, we looked at basically two solutions to this problem, and these have been proposed by others. So the first proposal is to forget about book to price. So book to price has a problem. So let's go to other measures of value. And typical measures you find are things like sales to price, cash flow to price, the dividend yield, etc. Now, this is the most popular solution in the industry. You have lots of material from index providers that basically claims, well, this is what you should be doing. So there's a paper by MSCI basically arguing that because of this problem that the book value ignores the intangibles, you need to combine several accounting ratios, and this will make you less dependent on this flawed measure of book to price. Now, there's another answer that has been proposed by academics recently, and that may be a more direct answer to the problem. So the idea is, well, the book value omits a lot of stuff that is actually relevant for firms' investments. So, well, let's try to not omit it, right? So let's try to estimate this. And so what in particular is excluded? Well, there's two types of intangible capital. The first is organization capital. So organization capital reflects things like the firm's relationship with customers, the firm's reputation, the firm's brand, a skilled workforce that a company may have. And as an example of a firm with lots of organization capital, you could think about a business consulting firm, for example. So clearly, the value, the book value of that firm, should account for the fact that this firm has invested heavily into its organization capital. Another type of intangible capital that is missing is knowledge capital. So knowledge capital, refers to improved processes, improved products that a firm has come up with because of its R&D. So firms actually invest into creating knowledge, so that can take the form of patents, but not only. That could be know-how that doesn't actually have, let's say, a strong legal protection, and all of this will also contribute to the firm's book value. Now you can go to accounting statements and actually estimate the capital in terms of organization capital and knowledge capital. So accounting conservatism means that these assets, they don't appear on the balance sheet, but you have some information in accounting statements on the company's expenses. And so you can estimate from R&D expenses how much knowledge capital the firm has built. You just have to basically capitalize these R&D investments and then depreciate them over time. And there's actually a standard method of doing that in the economics and finance literature. And you can do the same for organization capital. So part of the overhead expenses, so selling, general, and administrative expenses, is actually should be accounted for as investment into organization capital, because these are things like, advertising to improve the brand. These could be things like improving the skills of your workforce, so investing to training, etc., etc. So we can actually look at accounting statements, and from these expense items that should not be expensed, we can actually estimate the organization and knowledge capital. So that's what we do in this research. Now, what are the results when you pursue these different routes to solving the problem of intangibles? There, you see the results here in terms of returns. So what we're comparing here is again, first putting back the intangibles into the book value. We call that I book to price, so the intangible adjusted book to price. And we're comparing that to this popular solution in the industry, which is to say, well, let's forget about book to price and let's move to things like sales to price and other accounting metrics, and then also possibly combine all these metrics at the end into a composite. So here you can see the returns, and you can see that indeed, if you look at things like sales to price, earnings to price, you actually get a higher return for the value factor than you get with book to price. The book to price is the first item shown here on the left. So instead of a 2% annualized return, you get something like a 4 or 3% annualized return. So this probably shows why these alternative metrics are popular in the industry. They seem to generate higher returns. How about the intangible adjustment? Well, you can see that the intangible adjustment also leads to an increase in returns. So we find returns in excess of actually 4% once we put back the intangibles into the book value. Looking at these returns, however, is not really relevant question for investors, because think about what investors do. They're not going to invest 100% of their portfolio into the sales to price or the intangible adjusted book to price factor. What investors do these days is, well, they have access to multiple factors and they're going to design a multi-factor portfolio. So the real question for investors is, how does any of these factors contribute to my portfolio outcome? And it could be the case that a relatively low return factor is actually interesting because it could add diversification to the other factors. And on the contrary, a very high return factor might be completely uninteresting if it's just creates overlap with the other factors. So let's adjust for this possible overlap to other factors to get a much more relevant measure of the value added to an actual investor, who again is not just going to put 100% in value, but is actually going to look at different factors and combine them. So you see the results on this graph. What this graph shows in red is a measure of the value added of these different value definitions. So again, this value added just shows how much more return do I get from investing in this factor than what I could simply get from investing in other factors that this value factor is actually exposed to. So let's look again at sales to price and earnings to price. And you can see here that these very attractive returns of 4% and 3% that we saw, they actually completely disappear in this analysis. So both sales to price and earnings to price actually have zero or negative value added once you adjust for the other factors. And you see a simple explanation here behind that. So we're plotting in blue the exposure to the profitability factor. So high profitability is a rewarded factor. It's included in most multi-factor models. And you can see here that when you adjust for how sales to price is exposed to the profitability factor, you get actually a negative value added. And you can see that this exposure in blue is actually very high and positive. So what's going on here, and what explains this reduction of the value added relative to just the simple returns? Well, simply sales to price. If you sort on sales to price, you're getting a lot of companies that are highly profitable. And so this obviously makes sense because these are companies that have a lot of sales or companies that have a lot of earnings. If you look at earnings to price, it seems intuitive that these will be highly profitable companies. And so once you adjust for this exposure, you're actually not getting any value added. So in other words, using sales to price or earnings to price as a value proxy doesn't give you value. It actually gives you kind of value plus quality. And obviously value plus quality is a good way of generating returns. But if you already have exposure to profitability elsewhere, and if you have access to a dedicated profitability factor, then obviously there's no point in using these value definitions. The result is very different for the intangible adjustment. So we can see that the intangible adjustment produces large and significant value added even when you adjust for the other factors, and it has about zero exposure to the profitability factor. So this is just a summary and of our main result in the paper. And the conclusion that we draw from this is, I think, a very clear conclusion. So let's go back to the question, is the value factor outdated? Is, book to price outdated because of this problem with intangibles? Well, the answer is no, not at all. Actually, book to price works very well. You only have to measure it properly. And of course, it doesn't make any economic sense to exclude a lot of the capital, just because accountants are, very conservative and like to exclude them. So book to market is actually doing very well. You only have to measure it properly. On the other hand, composite value definitions and different types of valuation ratios, they may have been reasonable in the old days when people didn't have access to a quality factor. But if investors have access to multiple factors, these alternative value definitions actually do not add any value because they only add factor overlap. So that concludes the presentation, and we have time to answer some questions.
Yes, thank you very much, Felix. We have received one question. Have you tried, have you tried including the intangible adjusted book to price in the composite measure?
Okay, thank you for the question. We have indeed also tested what happens when we adjust for intangibles within a composite measure. And the main conclusion there is actually that it gives very similar results as for the composite measures shown on the slide before. So we looked at a very direct comparison between this intangible adjusted book to market factor on the one hand, and a composite factor in which we use the intangible adjusted book to market ratio, but we also combine it with earnings to price and cash flow to price, for example. And so we very directly compared these two approaches by, from the one hand, starting from a multi-factor portfolio in which value is represented by the intangible adjusted book to price factor. And in this setting, we see that actually if to such a portfolio you want to add a composite value factor, it's not going to add any investment value. It's not going to improve on the risk-adjusted performance of an investor. But then from the other hand, if we would start from a multi-factor portfolio in which value is represented by this composite factor, we see that actually adding this intangible adjusted book to price factor, it still adds value to the portfolio in the sense that it can improve the risk-adjusted performance of an investor. And that basically leads to the conclusion that all the information that is captured by such composite measure is actually subsumed by the intangible adjusted book to price factor, but importantly, not the other way around. And again, this is due to what Felix described before, to this factor overlap, that the addition of ratios such as earnings to price or cash flow to price introduces in your value definition.
Okay, thank you very much, Ben and Felix. So now we can move on to the third presentation by Frédéric on Scope 3 emissions.
Good afternoon. Stephen, can you confirm you're seeing my screen?
I'm seeing your screen.
There we go. Thank you. Yes, so I'm presenting a very short paper on Scope 3 emissions, and the motivation for this paper is the disconnect we are seeing between European regulation, where Scope 3 emissions have been included in targets for decarbonization at the portfolio level, and the approach that net zero leading investors are taking in respect of Scope 3 emissions, whereby they define targets at the portfolio level in respect to Scope N1 and Scope 2 only. So what I try to do in this short piece is to explain why it's important to care about Scope 3 emissions and how Scope 3 concerns can be integrated into portfolio construction. Then I highlight some limitations of Scope 3 emissions and the risks that arise when you use the wrong data in portfolio construction, and then offer some advice to investors who are willing to integrate Scope 3 concerns into portfolio construction. So first, it's important to underline that Scope 3 emissions are very material. Indirect emissions, Scope 2 and Scope 3, are associated with an activity, but occur outside of the boundaries of the activity as a prerequisite or a consequence of the activity. So it could be upstream the value chain or downstream the value chain. There is a protocol out there, a standard for measuring emissions by companies. And the protocol requires companies to measure and report their Scope 1 emissions, which are emissions of greenhouse gases from sources they own or control, but also report Scope 2 emissions, which are linked to company purchases and consumptions of electricity, heating, and cooling. And the idea of including Scope 2 emissions is that even though they are not directly controlled or produced by sources of the company, controlled by the company has some influence on these emissions, and these emissions are very material. Company may work on energy efficiency to reduce its consumption, or may approach the electricity provider to influence the type of electricity that is provided through contract or types of engagement. So even though this GHG, this greenhouse gas protocol only covers Scope 1 and 2. However, other value chain emissions, which are termed Scope 3, are the dominant source of emissions across most sectors. And you can argue that companies have some significant control over these emissions through their supply chain and product design decisions. They can choose their suppliers and to some extent the companies downstream that distribute their products, clients as well. And in designing products, they can also control to some extent how much greenhouse gas will be emitted at the product use and end of life product stages. Another reason why you could be interested in integrating Scope 3 emissions is that if you focus solely on Scope 1 and 2, you can get the wrong inferences when you analyze and compare companies. Think of companies manufacturing cars. If you look at the Scope 1 and 2 emissions from manufacturing traditional vehicles, they will be lower than those associated with electric vehicles. But if you include the use of the vehicles, so if you include Scope 3, and assuming these vehicles are charged in countries where the electric grid is rather green, the picture will change and the electric vehicles will be more attractive on a full life cycle assessment. Also, by disregarding scope 3 emissions, you could take the wrong decisions when comparing companies, because comparable companies may have very different ways of organizing their processes, different usages of outsourcing, for example. And if you think of Apple, all the manufacturing is outsourced. If you think of Samsung, most of it is in-house. Actually, Samsung is one of the companies that Apple uses for manufacturing. So if you just look at scope 1 and scope 2, Apple will look so much better than Samsung, when in the end they may be very close. So it makes sense to look at scope 3 emissions. Now, there are some issues, unfortunately, with scope 3 emissions data, and these issues start with the reporting. Unlike scope 1 and scope 2 emissions, the reporting of scope 3 emissions is voluntary in most jurisdictions, and it's also voluntary for compliance with the greenhouse gas protocol. Only scope 1 and 2 are required for compliance with that protocol. And since scope 3 reporting is challenging, scope 3 assessment is challenging, because so many sources outside of your direct control are involved. Reporting on a voluntary basis is quite limited, and is quite incomplete as well. There are 15 different categories of scope 3 emissions, and most companies will focus on a few categories. That said, pressure to report scope 3 emission is mounting. If you want to gain the science-based target label, you will have to include scope 3 emissions into your decarbonization targets as soon as they are material in your overall emissions. That's 40% of your total scope 1 to 3 emissions. Likewise, net zero alliances, both corporate-led and investor-led, insist on the need to report scope 3. And you're also seeing on the regulatory stage the introduction of sustainability disclosures that require investors to report scope 3 emissions or overall emissions associated with their portfolios. And we're also seeing regulation coming up for large corporates that will require reporting of scope 3 emissions. So it's very likely that scope 3 data, which is very scarce at the moment in terms of reported data, will be less scarce in the future. However, we should remember that the scope 3 standard is meant to help companies decarbonize across time, year after year. And a lot of flexibility is given to companies to assess what is material for them and choose the methods that work best for them in measuring and reporting scope 3. So the scope 3 standard is not meant to help compare different companies. So even though there may be more scope 3 data available in the future, it's not the type of data that will be relevant for comparing companies. So if you don't have data from the companies, you usually turn to a data provider that will come up with some models for estimation. So in that piece, I reviewed the different approaches to estimating emissions, and I find that these bottom-up or top-down approaches have in common a lack of granularity and specificity. That means that the estimates you are getting are mostly based on sector figures. Very little information that is specific to each company is taken into account in producing the estimate. At best, what is used is a breakdown of company revenues into activities and some extra activity-related figures, but there is little that is highly specific to the company that is used in estimation. So there are different ways to approach estimation. The simplest way is to take a peer group, measure the carbon intensity associated with the group based on the reported scope 3, and then look at the revenues of the company and multiply the revenues by the peer group intensity to derive an emissions number. So there's actually a provider out there on the market that does exactly that, irrespective of the poor quality of scope 3 reported data. Or you could have models that use revenues and a few sector-related pieces of information, but very often it would be the number of employees. So it won't get very specific. And these things rely on the data reported by companies that is not very reliable. There's another approach that takes input-output economic modeling. So works from the the country level emissions figures and allocate the emissions throughout the economic sectors. But then, well, your company emissions will just be the representation of the company revenues in each sector. You won't have any company-specific information that will be used. And when these approaches are extended by life cycle analysis, it's typically to look at the downside product use stage of emissions, and it is based on representative products. Again, not much specificity. The best hope is with bottom-up life cycle type analysis, but there's very limited supply of corporate data to be used. So again, you will be using high-level figures and sector level metrics, and that will also be more research intensive, and the subjectivity will be introduced. So different approaches, a lack of specificity, and it's no surprise to find out that the model scope 3 data is highly divergent across provider. So as a result of this lack of specificity, we underline that it's very dangerous to build your portfolio, to choose your stocks, especially based on scope 3 data, or for that matter, on total emissions, including scope 1 to scope 3 data, because scope 3 data in most sectors are a multiple of scope 1 plus 2 emissions. So by using total emissions, you drawn out the signal about what the company is doing on scope 1 and 2, and often reporting in a sea of product and sector scope 3 noise, basically. So for this reason, defining portfolio level targets, including scope 3 using total emissions, as was done in recent EU benchmark regulation, will encourage an approach that leads to disregarding the efforts done at the corporate level on scope 1 and 2. And as a result, should be viewed as greenwashing. So we do not recommend. It's one of the reasons why we were so bent against the metric innovation in the benchmark regulation prepared by the technical expert group on sustainable finance for the European Commission. And I mean, we were shocked that the TEG recognized how poor the quality of the data was, and at the same time defined the regulation in a way that very significantly provided incentives to choose stocks and weight stocks according to that data that cannot represent cannot capture the efforts made by company. So what can we do? What can investors do? Well, Scope 3 emission estimates are not worthless. They give you an order of magnitude about the emissions of a sector or a segment. And this can be useful when guiding your decarbonization efforts at the portfolio level for sector allocation, for engaging companies from these different sectors and segments. You can come up with some general idea of what the emissions are in the sector. And of course, it can be useful for reporting. You may still be able to use Scope 3 concerns, Scope 3 information in portfolio construction, but you have to be careful to use stuff that is specific enough to guide stock selection. There are some Scope 3 related metrics that can support security level analysis. For example, measures of corporate involvement in climate mitigation, obstruction, or contribution. Think of revenues from fossil fuel related activities, or on the contrary, from transition technology activities. So these can be used. You can also use fossil fuel reserves in your portfolio construction if you need to reduce exposure to the emissions related to oil, gas, and coal that are not captured when you look only at the mining and pumping of oil and gas. That's one possibility. There are other measures that are relevant at the sector level that you can look at to guide your sector, intra-sector choices, taking into account Scope 3 considerations. And there's a possibility of taking into account those science-based targets that companies commit to. As I mentioned earlier, as soon as Scope 3 is material for a company, and it's material in most sectors, the decarbonization of companies has to include Scope 3 data. So you may not be able to directly compare Scope 3 data, total emissions of companies, but you can compare how well they have been decarbonizing their operations. We also recommend that investors include Scope 3 considerations in their policy and issuer engagement, and that they advocate for reporting of Scope 3 emissions, standardization of Scope 3 emissions at the sector level and possibly beyond, and engage companies to adopt science-based targets that by nature will include Scope 3 emissions. So if you have questions, I'm happy to take them.
Thank you very much, Frédéric. No, we haven't received any questions, so we can move on to the next presentation by Erik Christensen on ESG engagement and divestment. Thank you.
Thank you. So I'll share my screen. Okay, so this article was about comparing and looking at the interactions between two ESG investment strategies, one being a divestment, also called exclusions or filtering, and the other being engagement or active ownership or active stewardship. So there are several reasons why we published this article. The first is that we wanted to dispel some misconceptions, or at least some commonly held views. The first one being that engagement is incompatible with divestment. The idea being that if you want to be an active shareholder, you need to remain a shareholder. So it sounds kind of obvious, and it's often good to challenge what sounds obvious. The second misconception is that divestment is a passive approach, in the sense that, or at least some people claim that if you divest, if a shareholder sells the stock to another shareholder, all that happens is a simple transfer of ownership, and nothing actually happens with the company itself. And some even claim that divestment could lead to worse outcomes for stakeholders. So, for example, if something is, or the management is behaving badly, and a concerned investor just transfers ownership into some investor who doesn't really care, the outcome for stakeholders, employees, for example, or could actually be worse with the divestment. So not only a passive approach, but potentially even worse. So these were two misconceptions that we'll get back to. The other point of this article was to show which levers, which mechanisms were in play for divestment to actually have an influence on companies. How does actually divestment work? And the third reason for the article was that, so we looked at divestment strategies, but we wanted to compare divestment strategies to other popular ESG strategies, which some people call integration strategies, or we call them mixed up strategies, in the sense that you try to mix the ESG signals, the ESG data, together with traditional financial consideration in one go, typically through optimization methodologies, for example. And we wanted to see how these mixed up ESG strategies compare to divestment strategies in terms of actually having an impact on companies, and thereby having an impact on the ESG goals that investors may actually have. So in terms of key results, first, we look at how divestment actually influences companies. And there's some theoretical and also some empirical literature on this subject. And what the literature shows is that divestment works or influences companies by raising their cost of capital. And this occurs in two different ways. The first being the most obvious. So when you divest, so when you sell a stock, you increase the supply of the stock. And if this increase of supply is not based on some new relevant information, this increase of supply should lead to a decrease in the price, which is equivalent to saying that divestment leads to an increase in cost of capital. But there is a second, perhaps even more important mechanism through which divestment raises the cost of capital. And this is when divestment is done very publicly, loudly, for example, through investor campaigns, so divestment campaigns, which are, let's say, very vocal. What happens is that this divestment campaign participates in the normative process. So basically, investors signal their willingness to change societal norms, and it may therefore actually threaten the license to operate of the companies which are targeted by the campaigns. And this threat to the license to operate means that the riskiness, the required return of the companies increase, and this is equivalent again to saying that the cost of capital increases when divestment campaigns are vocal and successful in changing societal norms. And this, so we need to think about, or investors need to think about very thoroughly how their ESG investment strategy actually provides signals to the marketplace and to other stakeholders at large, when they try to think about what the impact of their ESG strategy actually is. Another result is that, or what we have shown is that far from being mutually exclusive, so the idea that divestment, that you can't engage with a company once you have divested, that this is completely wrong. So as I said, it sounds very intuitive that in order to be an active shareholder, you need to remain a shareholder. But actually, it's completely wrong, at least in public markets where you have dispersed and evolving shareholderships. And this means that if you are, let's say, in a public market where buyers and sellers meet, and in this case, it's buyers and sellers of equity capital, when you are the seller of equity capital, so when you are the company, there's no reason that you should not speak to potential shareholders as much as you speak to your current ones. So this idea that investors or companies won't enter into dialogue with prospective shareholders is not verifiable in the public open markets. And also in practice, you can see that through, for example, with the example of investor coalitions, where current investors and potential investors coalesce, they work together to engage with companies. This is a practical example and a widespread example of how potential shareholders, even after having currently divested, can engage with companies, because companies know that these investors, if the company reacts to the demands of the investors, that they might become shareholders again. So not only this idea that divestment and engagement are mutually exclusive is wrong, but we can go even further to say that they are mutually reinforcing. And first of all, if you want to engage with a company, so it's basically a negotiation or a bargaining between a company and an investor. If you want to have a good bargaining position, you need to show some determination. And if you want to, let's say, threaten a company and you don't have any lever, then your bargaining position will be very weak. And so at least if you don't even have the possibility to exclude, if you don't even have the possibility to act, if you don't win the negotiation, it's very unlikely that the company will actually do anything. So you need to at least have the possibility to divest in order to have an effective engagement. But also, as I said, by sending signals by divesting, you actually reinforce your engagement in the sense that you reinforce your position and you send effective signals to companies. So in short, divestment is an effective way of engagement because you send clear and unambiguous signals to companies on what you expect as an investors, and you also show your determination and you show to society at large what your goals are, and you may influence these goals and thereby influence companies. Now, this, what we have shown here on the effectiveness of divestment is in stark contrast to what we see for other strategies where we mix financial signals with ESG considerations in one go when you try to build ESG portfolios. So here we analyze one very simple example of such a mixed up strategy where you mix perhaps the most simple financial metric, which is the market cap, and with a carbon intensity score, so carbon emissions divided by revenues. So it's a very simple example of a mixing strategy with one ESG signal and one traditional financial signal. And this is in the US market where we have done this analysis. And what we try to show is that this strategy, which purports to be a low carbon strategy because you take into account the carbon intensity of companies in the construction of the portfolio. So it's, let's say, a low carbon portfolio in the sense that if you calculate the weighted average carbon intensity of such a portfolio, it will show an average substantial decrease. But once you have this overall goal, it doesn't mean that at the company level, at the stock level, this decisions that you actually implement to build this portfolio over time will actually be meaningful in terms of sending signals to companies. And in the middle column, what you can see is that what we call deteriorators. So these are companies whose carbon intensity have increased over the last year. We can see that very often, almost half the time, the weight of these deteriorators, so worsening carbon intensity companies, actually increased from one year to the other. So this is a complete contradictory signal because you as an investor say that you have a low carbon investment strategy. You try to engage with the companies in your portfolio and try to see that. So you're claiming that you want to reallocate capital to companies who are more carbon efficient, but what you're actually doing in your portfolio is the contrary. You're actually increasing your allocation to companies whose carbon intensity has worsened. And if you look at the right column here, instead of looking at the deteriorators, we look at the worst 10% carbon intensive companies. So these are really the most carbon inefficient companies. And again, you can see that very often, sometimes more than half of the time, from one year to the other, you can increase the weight also in the most extremely carbon efficient companies. So you might have an overall goal, you might actually reach that overall goal in terms of carbon intensity reduction, but at the company level, the signals that you're sending are completely contradictory with your overall goal. And this means that when you're sitting down as an investor with the company and try to convince them to improve their carbon intensity, the discussion is likely going to be very difficult, because they will look at what you have actually done in your portfolio and they see something completely opposite to your stated principles. In this second example we have here is a slightly more what people would call sophisticated mixing strategy. So here we do an optimization. So we try to optimize low carbon score again, but we optimize that together with a multi-factor score. So this is let's say an investor who wants to reap the rewards of exposure to traditional factors that we have been talking about. So they create, in this example, a composite score between a carbon intensity score and a factor score. And the optimization is, let's try to maximize this composite score. And we compare that, and to make things comparable, we have compared that to a more simple, separated approach, where you, as we would do at Scientific Beta, divest from the high carbon companies, and within the investable universe of without those high carbon companies, we apply a multi-factor approach within that universe. So we compare, let's say, a screening and divestment approach to this optimized approach, and we ensure that both of these two strategies have the same level of expected tracking error. And what we can see here in this, when we analyze this optimized approach, is that again, in the middle column, we have the possibility that over time, the weight of the most carbon intensive companies, the worst 10%, might increase from one year to the other. So this means that, for example, even if the company is extremely poor in terms of carbon intensity, from one year to the other, for example, the factor exposures might have changed radically. So they might have become a sharp increase in the total multi-factor score. And you might then lead to an increase in the portfolio weight, for example, even though it's extremely poor in terms of carbon performance. In the right column, we look at yet another type of inconsistency, and we look at some of the worst emitters and how these worst emitters weight compared to a traditional cap-weighted benchmark. And we see that in some cases, even though you are in the top 10% of carbon intensity, you might be overweighted relative to a standard benchmark. So overweight a company which is extremely poor in carbon intensity and still try to claim that this is a low carbon portfolio is inconsistent. And again, this will probably lead to some difficult discussions when you try to have an engagement or a dialogue with the companies involved. So what we try to so in conclusion, it's very important when you look at ESG investment strategies to go a bit beyond the overall goals. It's not enough to have, or it's of course important to have a goal, to state the goals, but you should make sure that this overall goal that you have, it translates into meaningful investment decision at the stock level, because it's only by doing that that you can actually send clear and consistent signals to companies to make sure that what you're sending as a signal is not completely inconsistent and incoherent with your overall goal. And this signaling effect, as I mentioned in the very beginning, is extremely important, because it's probably one of the main channels through which divesting in particular actually influences companies. So when you have an ESG investment strategy, investors hopefully hope that their investment strategy has an actual impact on the real economy. And then they need to think about the signaling effect. And to have a good signaling effect, they need to think about what happens at the stock level, not only at overall portfolio level. And our view is that ESG filtering or ESG divestment sends very clear signal and therefore has a clear impact on companies. Whereas we have shown that mixing strategies where you try to combine ESG and financial signals, for example, through optimization, this can send very mixed, unclear, and inconsistent signals, and will therefore have probably much less impact on companies. So that ends this presentation. So
thank you very much, Eric. We haven't received a question, so we can move on to the last presentation by Daniel Haguet.
Okay, thank you, Sabrine. So I'm going to talk of the historical volatility adjustment risk control option, which is a new risk control option that Scientific Beta launched at the beginning of the year. So first, why do we offer risk control options? So when investors invest in factor strategies, they are exposed to some implicit risks or hidden risks that can affect the short-term performance of the factor strategy. For instance, you might have different sector exposures compared to the cap weight. You might have a lower market beta compared to the cap weight, so it means that you might miss some reward of the market. And of course, today we'll talk of the volatility risk, which is the third hidden risk that we commonly see for factor strategies. So when you look at the table below, for each of these risks, we can have one risk control options that will control for these hidden risks. And so if you look at the HVA, which is the topic of today, and you look at the average volatility deviation or the extreme volatility deviations compared to a multi-factor index with no HVA risk control options, you see that we can reduce the volatility deviation and the extreme deviation. So this is exactly the objective of each of the different risk control options, to focus on one hidden risk. So now the question is why volatility risk is important. Well, we plot in this slide the average volatility over the 45-year period on the US universe of a multi-factor index, and it's 1 year rolling volatility. And you can see clearly that there can be massive deviation from this average volatility. So the objective of HVA is to make sure that the average volatility is representative of the volatility risk of the factor strategy. So we want to reduce the deviations and to be as close as possible to the average volatility. And when you control volatility, well, there are academic evidence that show that you benefit from some important you have some important benefits. The first one is downside risk reduction. The second one is risk-adjusted performance improvement. And the last one is better conditional asymmetry. So behind this barbarian term, it's something very simple. So when you look at the market beta of the strategy in different volatility market regimes, when you are in a low volatility market regimes, you will have a very high market beta compared to the strategy without the control option. And when you are in a high volatility market regimes, you reduce the market beta. And so this market beta asymmetry in different volatility market regimes is really important to explain the benefits of controlling volatility over the long term. So to control volatility, you need to be able to forecast volatility. So what we do is that we use a statistical model that captures stylized facts of financial returns. So the main stylized facts are volatility clustering. It means that volatility is persistent through time. The leverage effects. So we observe that negative returns have more impact on volatility than positive return. Obviously, returns are not normally distributed, so you need to take that into account. And finally, we take also into account of structural breaks, which means that over a long-term period, your volatility might be affected by strong shocks to the market, like the financial crisis of 2008 or the COVID crisis. And when we compare a model, which is a Garch model, which is on the last column, to more traditional models like historical volatility, EWMA, or the VIX measure, we can show that on average or on extreme, we can improve the forecasting accuracy of the volatility. So this is a very important aspect of our HVA risk control options, a very good or robust volatility forecasting model. Okay, so now the question is how it works. So how do we design the HVA risk control option? So first, we do not trade the index, the multi-factor index itself. So we use a cap weight overlay, which can be replicated by futures. So it means that you are always invested 100% in the factor index. And then we have a cap weight overlay that you can be long futures or short futures to correct the risk of the strategy. So it allows to react quickly to a volatility change, and it avoids any turnover to the factor index. So there are three important design elements for the HVA. So the first one is the target volatility. So obviously you need to target a volatility, otherwise you cannot control for it. So we use the historical volatility of the underlying factor index. Then every week we do a forecast of the volatility of the index, and we compute an optimal allocation to the cap weight overlay. So the allocation is the ratio of the target and the forecasted volatility adjusted for the market beta of the index. And if this allocation, the change in the allocation compared to the previous one is above a buffer of 20%, then we implement the new cap weight overlay allocation. So this buffer rule is very important because you might have some noise in the estimation of the volatility. And so we avoid to trade too much in the cap weight overlay by having this buffer. So we limit we limit, if you want, the trade based on false signal that we can have. So now, what are the benefits of this HVA risk control option over the long term? So here we show some key statistics, 3 key statistics over 45 years, so since 1974 to 2019. We show the cap weight index on the US markets, the multi-factor index, and the version of the multi-factor index with the HVA risk control options. So first, what we observe is that we see clearly the conditional dissymmetry of the market beta in low and high volatility market regimes compared to the multi-factor index. So you see that the HVA version strongly increased the market beta in low volatility market regimes and strongly decreased the market beta in high volatility market regimes. The second benefit is downside risk reduction. So you see that the maximum drawdown is reduced strongly, and we also have reduction of 1-year rolling returns. When you look at the worst 5% returns, we have also reduction on that. And finally, the risk-adjusted performance is improved, so the Sharpe ratio. So we see that the improvement is not negligible. So these are the three main benefits of HVA that we see over the long term. Now, if we do a focus on 2020 and the COVID crisis, so obviously the first semester of 2020 was marked by the COVID crisis, and we see that the multi-factor index without the risk control options had similarly the same risk as the cap weight. So even if on average multi-factor strategies have lower market beta and lower volatility than cap weight indices, during this crisis, we observed that multi-factor strategies had roughly the same level of risk as cap weight indices. But when you use the HVA risk control option, you see that we were able to reduce strongly the volatility and the downside risk. This is also seen by the strong decrease of the market beta. It's exactly the idea of the conditional market beta dissymmetry. So the conclusion of this is that if investors want to keep the defensiveness of multi-factor indices, they need to have a direct or explicit control of the volatility risk, because volatility is time varying, and we see during the COVID crisis that factor strategies are not as defensive in some very specific crisis period. And so if investors want to remain defensive, they need to explicitly control for this. And the HVA risk control option is a good way to do that. So this is it. Severine, do we have questions?
No, we haven't received any questions. So this was our last presentation. Let me just see. No, there is no question or no raise hand sign. So thank you very much to you all for your time and for this presentation. So I will be sharing the replay of this presentation as well as the materials very shortly, and we of course remain at your disposal for any follow-up question you may have. Please feel free to contact us at the email address webinar@scientificbeta.com that appears on your screen. So thank you again to you all, and we will now end the webinar. Thank you.